All right, guys, thanks for joining us today. This is going to be an options workshop on long call calendar. It's also going to be a play. Long call calendar is strictly a play on volatility expansion. So this is a really fun one. That's one of the option strategies that I like to implement at this time. It's like the diagonal. When we're going out of earnings season, we know we have low implied volatility and we can expect it to expand going forward. So this is a great time to set this up, just like the long call calendar. That's why we kind of set up these earnings setup strategies right now. It's right after the earnings for the most part. We do have some bank stocks still yet to come out, but the earnings setup for some of the ones that have already played out, it's a great time. We've got a lull, and then we should see expansion. And Sonny, this is usually right around an hour, depending on, I will go over, depending on questions at the end. Let me go over a couple of things real quick. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I actually started trading in college with some money I had earned and was trying to get a psychology degree. And when I started trading, I really started getting into it. So I decided to flip my education over to finance and moved to Chicago and started working on the board of trade right after graduation. So one of the things I always said was psychology probably helped me out better in trading than my actual finance degree. So it is a very psychological warfare type of atmosphere. So the thing to do, I try and teach here, is to stay mechanical. Let all of that emotion and everything else go out the window. And one thing we also used to talk about on the floor was you got over that hump when you stopped thinking about everything in terms of money value, but probabilities and percentages. So if you can switch your mindset away from making and losing money and playing probabilities and making sure you are active and mechanical in that nature, you guys will be much better off. Anyway, I've traded everything in that time from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. So I've been through the thick of it for the most part anyway. Anyway, let me go over this disclaimer really quick. This says any opinions, news, research, and analysis, prices, or other information contained in here and any other material provided by ProTrader Strategies, associate companies, or employees is provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. At the end of the day, you guys, the reason why we have to say that is because we don't know what's in your portfolio. I don't know what your risk parameters are. So what I'm talking about and some of the stocks that I'm talking about could be counterintuitive to what you are already doing. So keep that in mind. Take what we're teaching you here, play around with it a little bit in accordance to your risk parameters and what's in your portfolios and implement it that way. The bottom line is do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. One other thing is I may be talking about stocks that I already have in my portfolio, and no, I'm not trying to get you guys to jump off the cliff with me. And I may be talking about different reasons why I think something's good or bad for certain situations. Take that with a grain of salt, you know. I mean, you may have more insight or something along those lines that may be more productive towards your portfolio. Hey, Trevor, good to see you. Thanks for the shout out. Should I hear sound yet? Yes, you should, Peter. Let me just make sure that he gets that. So anyway, one other thing is the Twitter handles we have here. Mine is at Wolfman's blog, and the other one is at ProTrader Strat. That's for ProTrader Strategies. You can get a lot of useful stuff from them. They will tweet out different other webinars or when webinars are coming about, and I usually will tweet out some trades and other snark, I guess, if you will. All right, so like I said, this is going to be on the long call calendar, and it is really strictly a volatility play, and that's what we're looking for with this strategy, is expansion and volatility. The last thing we really want to see happen is to have volatility contract on us. So we're going to try and set this up for that type of scenario. And the one thing that we can do with all of these strategies I talk about in these webinars is set ourselves up for success in the beginning and use these rules that I talk about and follow those, because that will give you the highest probability of success. Doesn't mean that it's always going to work out, but it will set us up for higher probabilities of success. So this is a long call calendar. It's a long horizontal spread in a sense, but we're going to be using the same strikes. So don't let this all confuse you here. We're going to be selling an at the money or buying an at the money, but selling an at the money or just out of the money call in the nearest expiration cycle, and then we're going to be buying that same strike that is at the money or out of the money in the further expiration cycle. So to set this up, what we're going to be looking to do is a few things really. Essentials to success: picking the right strike. Okay, so this is really important. Now, if you have a slightly more bullish assumption with this underlying that you find that works with all the parameters, then you want to kind of go just out of the money. I generally lean towards, especially with the call calendars, slightly out of the money, just because we've been on a huge bull run for one, and that ends up making this work out a little bit better. The thing I'm aiming for is to try and find about a 45 delta. So it's pretty close to at the money for the most part, but we're looking for like one or maybe two strikes just out of the money, depending on our directional assumption. If we think this is going to continue to go higher, then we'd probably pick at least two strikes out of the money for this. But the ultimate thing we want to do is have vol expand. Excuse me. Picking the right duration here. Now, with the right duration, a lot of times I talk about the time and expiration, but one thing that we need to make sure, like with the diagonals, is that our volatility between those two expiration cycles is very close to one another. And we want to keep that in line with that diagonal as well. We are going to be talking about less, right around 2% difference. Sometimes we can kind of stretch it out to 3%, but at the end of the day, I'd like it to be less than 2% for the most part. Asking why two strikes out of the money, that would be if we were more bullish in this underlying, thinking that it was going to continue to rally. Then I would probably lean towards two strikes out of the money. Otherwise, the higher probability trade is to do the one strike out of the money, or the 45 delta, whichever is closest. All right, the reason why we want these different durations is because we're going to be trying to take advantage of theta decay. And in that front month, that is going to be a clean month. We're not going to have a binary event in this front month because that's the one we're going to be short. We want to take advantage of theta decay in that front month, while this back month, we want to be taking advantage of the lack of theta decay. So this should decay faster, and that's where we're going to actually see our money or our profits come from, is this decay here. Now, the nice thing about this is the volatility. When volatility expands, we have a tendency to see when volatility expands, it actually holds off the theta decay. It kind of causes this in that back month to kind of start going like this, because volatility expanding will push this a little flatter in a sense. You can think about when volatility expands, it's like a balloon and you're blowing air into it. That's the volatility expanding in there. And when those premiums expand, it kind of holds off the theta decay. So that's what we would like to see happen back there. So we want the clean month in here, and then we want to see the volatility expand in here, which will happen, generally speaking, if we land that one that we're buying in a binary event expiration cycle. So that's what we're going to be looking for. Do you really want IB difference less than 2%, even if the long is after earnings or the short is before earnings? Yes, Mark. The reason why is because we want it to be less than 2% because, for one, we expect it to kind of expand in that back month, and that's what we want to take advantage of, because then we'll see our premiums go up. If we see volatility contract, then that's going to hurt us. That's going to be our worst case scenario, is when volatility really starts contracting. When I pull up the platform, I'll show you guys but how that works out. And if it is more than 2%, if it's like 4% or more, what you're doing is you're actually paying more for volatility in that further duration than what you're getting paid for here in the early duration. So it is really important to have that be pretty close, because we would expect the volatility to expand there. All right. Doesn't volatility expand during downtrends and not uptrends? Good question, Trevor. Yes, you will more likely see volatility expand during downtrends than uptrends, correct. But what you will also generally see is volatility expanding around that binary event, and that is where we're going to try and be pinning this back one in some type of binary event, okay? Is this vol BM minus vol FM? Can you go into more detail on that for me, David? All right, so that's what we're looking for in that. And the right environment, like I mentioned several times, it is low volatility, and we want to create a situation where we have that further duration volatility in an area where we would expect it to expand, given, say, a binary event. And picking the right underlying, we want something that has a lot of volume and open interest. We don't want to get into the ones where the bid-ask is really wide, because when you have to give up a lot of edge to get in and you have to give up a lot of edge to get out, that eats into your yield. We want a lot of participation, especially when things start getting volatile in a sense. You're going to see people get out of that market, or at least have their bid ask a little bit further away. They're going to not be willing to take as much risk on there. So if our scenario works out the way we want it and volatility starts expanding, we don't want that bid ask to get too far apart. Oh, volatility between the back month and the front month. So yes, we want the back month to be, well, we would love to have the back month have a lower volatility than the front month. That would be the perfect scenario, but that's like, you know, finding a needle in a haystack a lot of times. So in a sense, that's why we want it so tight. But if you could get the back month to be lower volatility than the front month, that's a great scenario, because then you're getting paid for volatility in the front and you're paying less for volatility in the back. Mark, so you need to enter this well before earnings, right? Yeah, you want to have one clean month of no events going on in that one that you're selling, and then have the one that you're buying in a perfect scenario with a binary event, because then the probabilities of volatility expanding are much higher. Now, Does that necessarily have to hold true? No, we could do this with ETFs and things of that nature where we would expect volatility to expand down the road. And we've seen like real low volatility, but you can do it in anything. But you really want to try and get it to where you expect volatility to expand. And the only way to really see that happen is when you pick very low implied volatility environments like we're seeing right now. And that, you know, volatility should revert back to the mean. If we are almost at zero across the board, picking those ones that are at their lowest volatility over the 52-week period, then we could expect that those volatilities will revert back to the mean or back to at least the middle of its range. And then that's what we're kind of trying to take advantage of. So you're looking to put this trade on before earnings. Will the short or the long strike be in the earnings month? The long strike will be in the earnings month. The short strike will be in a clean month. And I don't expect to necessarily hold on to this trade all the way through that earnings event. I would love to be able to take this off, you know, before that, the whole trade off before that. So the one few time that I will not take it off before is if it's gone against me. So if we're doing this as the long call and the market starts in the beginning going directionally my way, which would be down a little bit, and then have the expansion and volatility helping me out. But if that doesn't happen and the market continues to slide a little bit, that's usually when I'm going to leave that long call on because I've got nothing else to lose in a sense for that binary event. So I'll just take it in through that. Otherwise, I'm going to be trying to take this off before that time as a complete calendar spread as well. Does that make sense? Okay. And know your exit strategy before entering the trade. Now, one thing I'm going to show you guys, I'm going to throw up the Analyze tab. This trade looks almost exactly like, on the Analyze tab, a butterfly. So if you're used to doing butterflies, you're going to see that this looks very similar to that. But it also, in a sense, looks somewhat like a straddle, where it has a bit of defined risk. Because we're doing this as a debit spread, anytime we do a debit spread, we know our risk. But you'll see the peak happen right there at the very middle, and that follows along the lines of the straddle, where, you know, on a straddle I take much less of a % profit on that than my regular trades. So we're going to be looking at something around 30% in increase in value on this trade, and look to cover that. Now, if it goes against us, like I said, then I'm going to be looking to ride that long call out into the binary event, because, you know, the debit we paid is our max loss. So that is, we know what we're risking going into the trade. Now, one thing I want to mention with these profit and losses, I always do the max profit, max loss, and the break even. Because we have two different expiration cycles, it's very difficult to really say what our max profit is. And I'm going to show you that again on the Analyze tab, how the max profit can actually increase, even though it's somewhat of a defined strategy in a sense, due to volatility expansion. And our max profit could go down from where we originally thought on the initiation of this trade if volatility contracts. Ultimately, the max profit is unlimited because we have a long call in that further duration month. So if one would expect to have that short call expire worthless or expire, then we would have unlimited profitability to the upside with just that long call on, because that short call won't be in the equation anymore. But it's very difficult to figure out the max profit when it's done as a spread, because it is completely determined upon how volatility will affect our strategy. All right. And one thing is if you're profitable in this max profit scenario going into, like, say 5 days to expiration, if you're profitable in this, take it off, because there's no sense in risking more going into that binary event. If you've gotten that profit going into that binary event, then I would take it. And if you wanted to trade that particular underlying for that binary event, then set up another high probability trade around it to take advantage of that volatility contraction after the event, because we know volatility will contract right after that event, and if you've got that long call on, you could be directionally right and still lose money. So make sure you don't get bitten by that volatility crush that happens after that event. So take it off for a profit if you've got that profit. All right, max loss. Anytime we pay a debit, I mentioned this, anytime you pay a debit for a spread or a debit for an option strategy or an option strike, that is your max loss. You cannot lose any more than that, because you have the right but not the obligation to assign it. So nobody can come and, like, stick you with a option if you are the buyer. So anytime you pay a debit, know that that is your max loss on any strategy for that matter. And again, this is a ballpark figure on the break even. The long option plus the premium paid is where your break even is, somewhat to the upside. But again, it is really going to be determined by volatility expansion and contraction and how that affects these. So it could decrease after the front month expires, if you let that front month expire worthless and decided to ride this off into the event or up into the event in a sense. But that is a ballpark figure, and I'll show you guys that all on the trading platform, which we'll get into right now. After I think I got a couple of people asking questions, so I'll try and answer those real quick before we get moving too far. If the stock trades off like a bat, would you want to happen in the front or in the back month? If I wanted it, I would, if the stock takes off like straight up right away, that's probably going to hurt us a little bit more. But you know, the debit you paid is your max loss on that. And if it does reach a point where, you know, it goes too far, that short goes too deep in the money, take it off for your max loss for the most part before you get into a situation where somebody is going to assign you on that short call, right? Because we don't want that to happen. That just causes too many fees. It's kind of like a lawyer, you know, they're the only ones that make money in litigation, and that's kind of the similar situation when you get put stock for the most part. There are ways to manage it, but with this one, it's not worth it because it's the same strike and you're paying everything else. It just doesn't make sense. Okay. All right. So this is usually where I talk to you guys about throwing it out on the questions box. If you guys want me to look at some stocks, and we'll go through the setup here and how we will set up this trade and go through the rules step by step to make sure that they all kind of work out there. If we enter this trade, these 30 and 60 days before earnings, do you think it will make sense to simultaneously enter a long call calendar and a long put calendar in the case the underlying goes down? I wouldn't. I would try to have your directional assumption with this one for sure. I wouldn't do both of them because in a sense, if you do that, you're basically just doing, in a sense, it would probably set up more like a crazy iron butterfly in a sense. All right, so a lot of people are throwing them out there. So we've got MasterCard. So MasterCard, when did they have earnings? So yeah, this one actually looks pretty good right off the bat. So what I'm looking at right here is I'm looking at the implied volatility for the January. Oh, they don't have the, on Monday they will probably end up getting the Feb or something like that, or the March, I mean. But we could probably do this still because it's pretty close. Let's just see. I might come back to that one, David. Let's just because they don't have the right options cycle in there like some of the other ones. They do. This is what I was talking about with, we got $100 stock, and look how tight these markets are. It's 3 cents wide. So that's what I'm talking about. Make sure that there is a lot of volume and open interest. Anytime these bid asks are that tight, especially on something that's $100, you know that there is a lot of participation in there without even having to check like volume, volume and open interest. So you can see that there's a lot of open interest in all of these, and even today. So that's a good one for that one. We could look at Visa. And again, they don't have the Feb. They do have the March, but they don't have the Feb, which you'll get on Monday, because once this cycle comes off, that's usually when they'll throw those out there. And again, Visa has very tight bid asks on there. Like, let's check out XLE. It's just because we're going to be missing that month that would probably have their earnings event in it. So that's why I would rather go to something where we can kind of nail it with that earnings event in there. All right, XLE. So let me change this so I can narrow it down, because we're going to be going pretty close to at the market. And XLE, I'll get those too. It looks like it would be a good one though, XLE too. So it's a little bit far apart though too. So see, the further out you get, those volatilities are going to expand a little bit more, and it doesn't allow us to fit our rules on the tightness of these volatilities here. You know, you could go into the weeklies. XLE would work with the weeklies, because I know that they're going to have tight bid asks in here as well. So we could even just look at this for the weekly. So one thing I do kind of like to check is the charts. So XLE's had a nice little pullback, and if you're bullish on the energy sector, then, you know, and they've had their pullback, this could be a good time to put something like that on. So I would look at like this 77s. Let's just check out the deltas on this. So right around the 45 delta is pretty perfect for this strategy. So we're going to go with we're going to sell this one here, and then we would go a little bit further back into the 42 days here and buy this one. So, and it's got extremely low implied volatility percentage. You can see it's pretty much low. So if we go down here and look, I mean, it's at its 52-week low. So we could expect that volatility would start to pop a little bit in here. So let's look at this on the Analyze tab. So if we analyze the trade, one thing we want to look at for this trade in particular is we want to make sure that our debit, or our max loss in a sense, is going to be less than what we have the potential at this time to make, right? So we're going to be looking at that. We also want to check out our break evens and things of that nature. One thing we can do is, I like to look at the standard deviations and put that on there, just to give me the idea as to where it is. You know, obviously the closer to one standard deviation our break even is, the better. So that's another thing. And you can see where the underlying is trading in here. So this shows us that we do have a slightly bullish assumption in here. You know, you can set it up where You go even a little bit further out, and that makes us even more bullish on this assumption. If we went to the ones that were going to be deeper, or the at the monies for the most part, or just slightly, or closer to it anyway, then we have a slightly bearish assumption. So we'd want this market to come back down a little bit, but that's where we need to make our decision if we're slightly more bullish or slightly more bearish in that sense. So let's see how that changes the situation a little. But let's go back to our original one with the 77s. Now this is what I was talking about. You can play around with these numbers here. So you have a gearbox. So if volatility expands for us like we want it to, this is, as you can see, our profit starts increasing. That's why I was saying our max profit is very difficult to determine. This is if no days go by, we can or we can change the prices too, but we could change the date here, like say it took a couple of days for this. We can change all of these scenarios around with this. That's kind of nice about this. But if volatility increases, you can see that that starts going up. Now, if volatility continued to decrease, in a sense of going back to normal, you can see what would happen if we had this on with that higher volatility and it continues to go down. So as it would go even further negative, you can see that our max profit starts decreasing more. So that's why it's important that we get something that's really low, because really what we want to see happen is that volatility to expand like this, and it jumps a little bit, makes it look a little funny because it went too high on the chart. But you can see that the max profit is increasing, and our break-evens are getting further and further away from where we are. So it increases our break-even as volatility expands. That's why it's really important to get that to happen. Does that make sense for everybody? That's what I wanted to explain about how we really would like to see the volatility expand. And that's why we're trying to nail that binary event, because we want that volatility to expand in that further duration month that we're long. So that would be one way to set that one up. All right, so the other one is, who else? Sorry. Altera. So Altera, I know, has pretty good markets, 10 cents wide. One of the rules I talk about also, I forgot to mention this on the making sure we pick the right underlying. I don't know if I mentioned this. Anything that's under $100, I want to make sure that the bid ask in that front month is inside of 10 cents. So that's what we're really looking for. So this is really the front. I know this isn't expiring today, but this is really the front month. We want to make sure that these bid asks, and you guys are picking great stocks that have a lot of implied or a lot of open interest and participation. And so these are great examples of it, that they're really tight markets. 4 cents wide on a $60 stock is great. Something like Tesla is also another good one. One thing I talk about, if it's like over $100 stock, move the decimal 3 ticks to the left, and that's how wide your strikes should be within that. So if it's like, say, $300 stock, the bid ask on that front month, like in January here, should be no more than 30 cents. Does that make sense? On picking the right underlying. That's a good rule of thumb to go by. And if it's $1,000 stock, you move it 3 ticks to the left, those bid asks should be like $1 wide. And you'll see that that does hold pretty true, especially with the big ones that are pretty popular, like Chipotle and Priceline, stuff like that. All right, so with Altera, 20 cents here, and we don't have the other one, but we could go out here to 20 ticks to 21. The other thing to check would be when their earnings are. Make sure we kind of get that in line. And their earnings fall in that second month that we'd be looking for. So like on Monday, we could be looking to do this because I bet it's pretty close to in line. Yeah, David, I'll do a price line one here in a minute. We'll do it here in a second. I got a couple more to go over. So Capital One Financial, this is a good one. I'm pretty bullish on the financial sector. It's got pretty low implied volatility. Their earnings come in right after on the 24th of January, so that would land right in here. Oops, more right in here. So that would be the one where we see the expansion, and this is the one where we have no event happening. So let's look and see what their ones are that they don't have. Everybody's surprised that Capital One Financial does not have the right one, but it's 3 ticks wide on that one. So let's look at price line. See if price line's giving me the right. What is price line? So price line, let's say, so this is what I would say, $1.50 wide. So in the front month, we'd look for something that's $3 wide. That's pretty wide. I know there's a lot of participation in here, so I've traded price line quite a bit, and you usually won't have any problem getting filled off of the mid price. So the one thing to look at, they do have the February, so, but it is four ticks wide. So 2160 to 2570, that's a little too wide for me. Let's look at all right. So this is another one. So we get our February in here. We've got 5 cents wide, $30 stock. It's 32.79 to 34.25. So that gives us the right parameters there. All right, so their earnings come at the end of January. So that falls with, or sorry, end of February. So that falls in line with our rules there. So we could expect to see, we're not paying too much in volatility out here. So we could look to sell around the 40 strike, which is the 37.50s. That gives us $1 move to the upside. So we're going to want to sell this one and then buy the same strike, which we aren't getting. So we probably 39s. So we could just do the at the monies because we're not getting, the reason why is because this has got the half strike here. We don't get the half strike here, and we want it to be the same. So let's just go for the 36s because we can get that one as well. We can get that. So the 36s. All right, so that sets us up right, 56-cent debit. So let's look at this one on the Analyze tab too. See. How do you add the monkey bars? You know what? I'll talk about that at the end, David. All right, remind me at the end. So this one looks pretty good because you can see our max loss is going to be 56 cents or $56. And our max profit is better than our max loss, so that's good. We want that to happen. We've got good volatility. Because we had to pick those ones that were just slightly in the money, you can see that we have negative delta. So we are slightly bearish here in the beginning of this trade. So we want this market to move down a little bit because we are negative deltas. And negative deltas means you're biased to the downside, and positive deltas means you're to the upside. But this one's pretty good. Look how close to the one standard deviation. Oh wait, let's see. Let's just change it. I mean, I can see it, but I want to make sure you guys can see that it's really close to the one standard deviation move, and then negative. So you can see right here on these lines, that's the one standard deviation move to that side. So we are pretty close to, it's really 1/2 a standard deviation probably for all intents and purposes. This is another situation where we want to look at what would happen if volatility were to expand on us. And as you can see, it starts moving. Our break even's a little bit wider. Yeah, the standard deviation moves because that has to do with volatility as well. But you can see we don't lose any more money, and we continue to have a higher potential for profit if we start seeing volatility expand during that earnings month, which is in February on the January 20th, I think I said, didn't I? Is there earnings? Oh, sorry, February 20th. February 20th. So it's actually right on the outer end of that. So that one would not work. Yeah, February 20th. So we probably wouldn't see the volatility expand in this if the earnings happen after this expires. So after all that, it's probably not a good example. So let's go on to a couple other ones. He's got Disney. Let's look at Disney. So Disney looks like it could be a good one. 1704. It's just made it inside of our 2%, so that looks pretty good. We're trading at 105 or 103, so 104-ish. So we'd probably want to pick these 105s here. Gives us a lot of room. It's also the 40 delta, which falls in line with those rules. So we want to sell that 105 strike, buy this further duration 105 strike. We're going to have to pay $1.15 for this one. So we can check it out on the Analyze tab again. What is the 40 delta rule you're referring to? So for this particular strategy, the out of the money strategy, I'm looking for about a 40 delta. And, that roughly correlates to a 45, 40-ish delta, a 55 to 60% probability of being out of the money at expiration. So that's really what I'm looking for with that 40 delta. So great question, John. That's why I want a higher probability of being out of the money in my shorter duration. So then, I don't want it like a 50-50 chance. It's just not, it's a flip of a coin in a sense. So I want to try and pick it a little further out. If you go further out of the money, you are more directional though then. So keep that in mind, and, your probabilities get a little wanky. Yeah, you have a higher probability of being out of the money with that short call, but you're having a lower probability of being a much lower probability of being in the money or closer to in the money at expiration. So you got to try and weigh those. I like to try and get it where my probabilities are a little bit better of being out of the money in the beginning than just 50-50. But you could and play around with that. What is the benefit of being close to being in the money at expiration? Well, if they're just out of the money, then they're going to expire worthless or because they're out of the money, right? Where then, that back month is very close to being in the money. So you're going to get the most theta decay out of that front one, hopefully get some volatility expansion in that back one that has the binary event, and that's going to pump those premiums up back there. So that's that's your best case scenario. I'm generally not going to take it that long into that expiration. I'm going to be looking to try and cover this sooner than that, but that would be if you were really riding this into the sunset, a situation where that would be the perfect scenario. Binary event meaning theta and binary event. When I'm talking about a binary event, I'm talking about the earnings. A binary event is a known event in the financial world in a sense. So when I'm saying binary event, that could be anything, you know, like we just had a binary event on Wednesday, and that was the FOMC meeting. So, you know, we had a binary event on November 7th. That was the election. So it's like a known event around financials that could possibly increase volatility. That would cause the theta and the volatility impact, right? Absolutely. And when volatility expands, it synthetically holds off theta from happening in a sense. And then when that volatility contracts, it allows theta to come out. So that's why we really want this volatility to expand. And usually we can try and time that around that binary event. And my profit target is about a 30% increase, correct? So if I'm paying like the $1.15 here, that would mean that I'm trying to get about 35 cents out of this. So when it's trading $1.50, that's when I'm probably going to be looking to cover this, which isn't that hard. You know, I mean, if we see that it goes to the 20th, which is just in a couple of days, and we just saw volatility expand a little bit, you can see that we could easily get that to happen. I mean, just with a 1% increase in volatility, 1% of the percent increase in volatility. So we could easily see that start to happen. One thing with this one was, the way we are right now, I want to get this back to today just to make sure that we are comparing apples to apples in a sense. It's looking like we are risking more than we have as a profit in the beginning. I don't know. I put this one on the short list, but at the end, because the break-evens are pretty good, we are directionally to the upside with Disney. I put it on the short list, and one caveat is I'm risking more than I'm able to make, so I might hold off on this one. You want the earnings date to be after the expiration of the front of my short call, and we want the earnings to be in the let's pull up this one. So I want the earnings to be landing in I want this month, which is the one that we're looking at for our short call, to be in the clean month. See how there's nothing happening? We just had their dividend, they had their earnings not too long ago. So we want this to be clean. That's the one that we're short. We want that theta decay to happen. But we want the volatility, as you can see going into this is a binary event, this is an earnings. You can see that volatility ramps up almost all the way to the earnings here. And usually you'll see them top out. And then after the earnings, you get that big drop. So here it kind of isn't a very good example, but generally speaking, you will see volatility expand into that earnings event. So we could expect to start seeing volatility start to expand, and volatility is going to affect that month with the binary event in it the most. Right, that's why you got more with this Disney trade. We have more risk of a loss than we have of a gain. So that one might not make it to the final cut. So, but you know, you can put it on the short list. It's got everything else, and if we're really bullish Disney, then you know you might be able to put that one on. Anybody else have any other ones that I missed on CVX? I think was one. So let's check out CVX. Delete this. All right, so Chevron, bullish because fracking is going to possibly, if they start crimping oil, I mean, the way I would look at it is, you know, if the Saudis actually stick through with their sanctions, then fracking could be a big thing again, and it would help out Chevron for sure. So let's look. We got the February, so that's good. It's inside of that 2% rule. You know, the volatility here, 1842, the volatility here is 2039. Need to look at their earnings. So let's check out when their earnings are. Make sure they get up. Didn't want to give it to me. Oh yeah, did I not do Priceline? Sorry, I'll try and get to it. So yeah, our earnings are going to land in there. Got a clean month here. So that's good. Meets our rule of thumb here. Meets our rule of thumb here. It's inside, it's a $100 stock and it's inside of 10 cents. So that's easily within those parameters. So let's look at it. So the 20 strike is the one that's going to be as close to the 40-ish as we can get. So we're going to do the 120 strike, sell the 120 there, buy the 120 here. Let's check it out on the Analyze tab. So we can analyze it. Let's just click to get our standard deviations. Make sure those are in line. And then we're risking $1 exactly to make just over $1 here. So that would work out pretty good for me. I mean, it's risking 1 to make 1. We do need a directional bias to the upside. We definitely need it to go up and tag that 120 for our max profit on this. So this is what I'm talking about. You'd be more bullish in this. So you'd have a more bullish assumption heading into this trade. Where do you see the risk 1 to make 1 analysis? At this point, we're risking $1 here to make our max profit of, just over $1 here. I mean, it's a little bit more. I mean, of course, I'm being a little biased to it on that, but it's pretty close. It's close enough for government, right, David? All right, so let's check out Priceline real quick. I thought I did check Priceline, but Priceline's got the Feb, okay. Oh yeah, this is why I discounted Priceline, you guys, is because Priceline has too big of a difference between the 2 months. I mean, it's 4. It's almost double what our double our rule, which is putting that, you're paying, in my eyes, you're paying too much for that back month option. That makes sense? All right, so let's look at Expedia. See how it works out. Expedia doesn't have those February months, but we could look at this because it's a $100 stock. It's 10 cents wide there. Another thing you could do is look at, because right there, if you remember that volatility curve, after 35 days, you start seeing that acceleration in, it was the theta curve. You start seeing theta start to pick up here. So we could look at 26 to 27. We also need to check and make sure that we can get our earnings cycle in there. Oops. Here's my chart. So let's look at this for Expedia. So that puts it on, we need to make sure the 9th of February. So these would expire in January. So we need to get the February ones. So I'd probably wait till Monday to look at this one, because on Monday we should get those February contracts for Expedia. Do I look at IV of the IV percent? What I'm doing over here, this is the IV, right? The implied volatility. I want to make sure that the Vega is within 2. And then I'm also looking over here at the current IV percent, which is 9%, which means that it is at the lower end of its range. Now, one thing with this one, because we had this huge spike back here, we could figure out the IV percent, which is pretty easy calculation. IV percent is basically where the current IV is minus the low. There's a numerator and a denominator, right? On the top of the numerator, in the bottom is the denominator. In the numerator, we want to take where the current IV is, which is 0.25, and subtract that from the low, which is, let's say, 19, or let's just say 20 for math. So we got a difference of 5 in the numerator. So 5 divided by the high, which is 74, and the low, which is 20. So we've got 5 divided by 50, and we can see that that would be close to 10%. Or what did I, sorry, 5 divided by 50, and we can see that that's close to 10%. So that's how you figure out IV percent. That's how this is calculated. And this is going to throw that off quite a bit a lot of times. So, you know, that's a rule of thumb that we used to use on the floor. If there was something crazy like we would see in maybe like Lilly just had a trial, a drug trial. So you can see that this is an event that wasn't around this binary event. It was a binary event, but this is not going to happen all that often. So this is going to throw off our calculations for the next year. Is likely not going to get that high in implied volatility around one of these events, one of these earnings cycles. So you're going to need to know stuff like that if you like to trade Lilly in order to discount that. So it's the current IV minus the low, divide that sum by the high, which you would make now right around here, minus the low. Does that make sense for everybody? And that's how you come up with IV percent. So that would be something that you would need to take into your equation, because otherwise, especially with low IV and, well, even high IV, that once it gets back to the normal high here, it's going to say it's probably a 50 IV percent, which isn't really true. So those are things you really need to know. How do you set up the chart? It should have it on those. On this part of the platform, it doesn't do it, so I have to pull up the other one. But if you have it on expansion, it'll show where they are going forward. Yeah, because if it ends right here, it's not going to show you where that earnings is, so you have to have it on expansion. All right, so let's just look at Lilly while we've got it up. See if Lilly has those. It does. See, Lilly's bid ask is a little bit wide, although there usually is a lot of volume and open interest here. Yeah, you can see there's a lot of open interest in this. So, you know, one thing I always say, you know, if you know that there's a lot of volume and open interest like there is here with Lilly, I can assure you that, or almost assure you, I don't make any guarantees, but it's tighter than this a lot of the time. So having said that, anytime you guys put in an order, don't ever go just to the mid price or the bid, especially if you're just buying or selling just a single option. It's going to try, they want you to get filled immediately, right? They don't want you messing around. They want to fill you and bill you, is what we used to say on the floor, because they want to bill you for that brokerage, right? But if you sell too low, that costs you money, because you might have been able to get another penny or two better price if you just had taken a couple extra seconds, because somebody else is going to see you in there and hit you on it. If you go just to hit the bid, there's not enough time for it to fill you better. But if you're going to sell it, go a couple of ticks above where the mid price is, or a couple of ticks below where the offer is if you're trying to sell it. Like for in this case, you know, start at 120. just better the market and cancel replace, because a cancel replace doesn't cost you any money. But if you get hit and you sell 104s, that could have cost you money, because you probably could have gotten filled at like probably 110 or 115. So it costs you like 10 cents. So make sure you start out higher than where you think you're going to get filled, cancel replace. And I'm not saying wait 5-10 minutes. Put it in. By the time you go back and adjust that price, you should have either gotten filled or you're not going to get filled, and then cancel replace it as you go down. All right, so let's just take a look at Lilly, because it fits within the parameters. And if, like I said, if you could ever see where it was below, the volatility was inverted here, that would be great. But I bet the earnings aren't going to be coming into that month that is actually lower. So we look at Lilly, see that the earnings are on January 31st, and these expire on the 27th. So that's why there was very little volatility in there. So we could look to sell these, even though the bid ask is wider. I know that the markets are tighter in here. And look to buy these. So in this regard, see, we're like 20 cents off. So I would pull this up, like 10 cents, excuse me, and then enter that trade and cancel replace. Go down, 2 pennies. Cancel. By the time I go back, cancel replace, go down, cancel replace, and just keep working that down. Try and get a better fill, right? And then let it sit at the mid-market for a little bit, if that's how far you have to go down before you get filled. So let's analyze this trade. Let's get rid of one of these. Which one did I just put up? Which one did I just put up on there? 75s. 75s. Let's look at the, I had something in there. This is one of the ones I kind of vetted beforehand. So it looks like this is the one that's now Lilly rallied since towards the end of the day. So we can look at the chart of Lilly. It was actually down quite a bit more earlier on in the day. But having said that, they missed out on this whole big move to the downside off of their trial failing, and then the market's kind of retraced right back to the point of control. But this looks like it could have topped off and blown off of steam. Today's a quadruple witching, which is another reason option expiration. They try and always send it back to where the value is, point of control, because that's where the most money is. That's where the most time volume has been spent trading. This is right there at the $73, $74, let's call it. So they try to get it up there for settlement, which you'll see a lot. So now we could see this be exhausted out a little bit and come back. So that fits with our mantra there. So we've got these 75s. Let's just analyze the trade here. Let's get rid of that one. So I did it twice. So we're risking 75 cents, and our profit potential is a little bit higher. We obviously, because we're at the 75 strike, need a bit of a rally. We could change this to those 72s. So let's just look at the 72s here. I can go like this and redo it. And look at that one. So this is, we're risking $65 to make just over $100. So the reason why I betted this one is it was looking to me like it was almost a, at the time when I put it in here, it was looking like I'm risking one to make two, and that would be a great scenario. If you could risk one to make two, then that would be a really good green light. So I've kind of run a little bit long going on this. Does anybody have any other questions real quick before we wrap this up? I want to keep you guys until Sunday. What are the four short vertical lines in red? those are like different break-even points. So this is your actual break-even point. This is your break-even point on the near term. So like once you put this immediately on, that's kind of like your break-evens. I really don't even look at the purple. It has to do with, you know, you'll see that go up as time goes on and go up and out. So see, as you can see, the time goes on, and if the market didn't move, then that's where we would be. Does that make sense? So I don't even really look at that. All right, so and then do you email the recordings? We do email the recordings, Peter, and you should be getting those. It takes me a little bit of time to convert the recording, especially because we've gone over a little bit, but it'll take me a little bit longer today, but after a couple hours we should get it. And this is going to be our offer for today. You guys, 2 for 1, 2 months for one, the price of one. You get my daily market commentary videos, trade analysis, everything I see in the markets. I talk about the FOMCs. I talk about the different earnings. I talk about also the economic data points that come out every day and go into analysis on those. And then I talk about every single trade that I put on and take off. So you get to see the good, the bad, and the ugly. And when it's bad or ugly, you see how I'm managing those trades. I don't just like completely throw my hands up in the air all the time, and I show you different ways to manage that risk. You know, I had Lulu go against me. I actually even had that Lily trade go against me. I was involved in that whole trial situation where the volatility kept expanding on me, and I was short premium in there and ended up putting on a really big wide straddle or strangle on it, and showed basically live how that volatility crush that we saw in that chart, I was directionally wrong. I had on the 65 puts. It went down to those 65 puts, and I was still able to make some money on that trade because of that volatility crush. All right, so I go through all of that in those daily market commentaries as well. So you also get access to the 50 online options trading workshops. That's basically everything I've ever done for the most part. And then you also get access to the trading lessons video archives. Those are like shorter, concise, so it's like a little bit of a refresher, so you don't have to necessarily watch the entire webinar over again. You can kind of get the little refreshers on it and the trading lesson videos. Plus you also get the members options trading courses, so that's a great value, 2 for 1 right now. You also get access to me, you guys. Anytime you guys sign up for these, you get access to me. So a lot of you guys have been taking advantage of that. When a trade goes against you, or if you're wondering about what my rules are around a particular trade, I have a no email inbox policy. That means that if you guys reach out to me in an email, I will get back to you as quickly as humanly possible, because I know I don't like to be on the hook either when something's going awry and you want some answers. So I'm, you know, top of mind with that, getting back to you guys. And I know, thank you, I appreciate that. You know, I'm getting back to you guys right away. So I hope you guys can take advantage of that, like a lot of people have been doing lately. So, and if I can't answer that in a short email or what my rules are and stuff like that, I would be more than happy to get on the phone with you and make sure that it's taken care of, because I want you guys to be successful. All right, so take advantage of that. The link to this video is in the chat box. It's not going to come up in the questions area. So if you look right over there in the chat box, you can click on that to get that special deal. This is also the link right here, Pro Trader Strategies Premium Subscription Offer. You can't really click on this, but you could, at a later time, you can pause this at any time and write that down to get that offer. So in later webinars, we're going to be drilling down on other options components, how to trade options, trades I find, when and where I find them appropriate. Also, if you have any videos you want me to cover on a particular option strategy, reach out to us. If I haven't covered those, I'd be happy to cover them again. And if you're one of the newer students and I haven't done them a particular one in a while, then I'd be happy to go over that as well. But you can call us at 310-598-6677 or email us at trading@protraderstrategies.com. So I think somebody was asking me about this is again the link, about how to set up the market profile. I actually, in those videos, I go over all that. It's basically a series of clicking on the beaker on the chart, and you can type all that stuff in. It's market profile and volume profile and monkey bars are what those two are. Can you day trade credit spreads profitably? Only if you are directionally right, and I don't usually day trade credit spreads. I do use the market profile sometimes to trade futures and stuff like that. That's usually when I'm kind of working with that. I love the market profile for long-term and even on a daily term thing, and I actually go through that in the videos, how to trade that market profile on a daily type of scenario. I don't talk about my futures trades in the daily market commentary because I specifically like to keep it to options. The futures trading is more of an engagement thing for me, more so than trying to make a lot of money. Does that answer your question there? Hey, David, or John, sorry, don't worry about asking a lot of questions. I appreciate it because there's things that you're wondering that other people aren't asking, so always ask the questions. So don't worry about that. You can reach out to us at reach out to me at trading@protraderstrategies, and they'll get you off to me. Do I ever trade future options? I do sometimes. I usually stick to the ETFs though for the most part. Okay. All right, great. I think I got everybody. All right, guys, have a great weekend. Appreciate everything, and I appreciate you all. If you can't take that, take it easy. Have a great weekend. Take care. Thank you. Bye now.